Dr. Babasaheb Ambedkar Open University.
Hello friends, welcome again in the course of Fundamentals of Financial Accounting. As we discussed in the last module, that is classification of accounts as well as the golden rules of accounts. Classification of accounts, as there are three accounts: personal accounts, real accounts and nominal account, and their respective rules, how it actually works. Personal account, we know that the personal account, it is actually the receiver, or who is a receiver, the receiver is always debited, who is a giver, giver is always credited. What comes in case of a real account, it is debit, and what goes out in case of a real account, it is credit. And in case of all the nominal accounts, expenses and losses are debited, where the gains and profits are always credited. So that was the briefing about of the last module. Now moving to the next part, here we are going to discuss today the fifth module, that is the dual effects of transaction. What is the dual effect of transaction? As when I was explaining in the previous units, in previous modules, then any kind of economic transactions have a minimum twofold effects. The two effects are there. So there are two effects. One, maybe it is actually, maybe either it is comes in or goes out, or it is considered as a part of who is a giver and the receiver, or maybe the expenses or an income. So ultimately, any kind of transactions have a two effects, twofold effects. So each effect has a certain value. So I want to tell you here that whatever the amount is actually debited, the equal amount has to be credited. So it has to be balanced. The equations should be equaled. So in that way, the dual effects comes into the picture. Now here I want to explain the dual effect of transactions. Let's move the part of the next slide. Here the key takeaways in this particular chapter, we are going to discuss the what is dual effects, how the dual effects is actually having transactions, what kind of transactions are there, and the transactions have how many effects. Then the classification of business, the different kind of a business having a different kind of activities, and in that way the how this business is actually having an activity and applied a twofold effects in the books of accounts. Then the classification of transactions, each different type of transactions, maybe a debit transactions, credit transactions, revenue transactions, expenses transactions, maybe the purchase of assets or a sale of assets, or any kind of brought the capital in the business, maybe the withdraw the amount from the business. So such kind of transactions are there. So that is the classification of transactions. Dual effects of transactions, as I mentioned here, any economic transactions have a two minimum effects. So minimum two effects are there. So that's considered a dual effects. Like an example, if I want to tell you 5,000 rupees brought cash in the business. So how the transactions can be identified? The 5,000 rupees cash brought into the business, the cash comes in, that's a first transaction. And the second effect is who brought this cash in the business? Owner brought cash in the business. So who is a giver? Owner is a giver. So there are two effects. One is the cash comes in, owner is a giver. So there are two effects of each transaction. It's the dual effect of the transaction. Moving to the next point is types of accounts affected by the transaction. As we discussed the two transactions in the previous example, as I mentioned here, cash comes in. So cash comes in, it's a first effect. Who brought this cash? Owner brought cash in the business. So owner is a giver. So here the types of accounts affected in the each transaction. The transactions, how many accounts are affected? Two accounts. One is cash, because of the cash comes in. So account number one is cash. Who brought the capital in the business? Owner brought the cash in the business. So it's a form of capital. So second account is capital account. So cash account and capital account is affected in this transaction. So we need to identify the accounts affected in the transactions. Moving to the next is, we'll discuss also at the end of the whole theory, we'll discuss one example also to polish how this chapter is actually important for the further accounting entries and understanding of the subject. Moving to the next point, let's start with this first introduction. Here, The business transaction is actually any kind of a financial transaction which has a monetary value will have to be recorded in the books of accounts, that which we already discussed. Here the business transactions we need to identify first, and these business transactions have a financial activity as we mentioned. So any kind of a financial activity, or you can say that any kind of transactions which have a monetary value which is affected to the business, then it has to be involved with the exchange of a value money, or maybe can be an exchange with the goods also, or it can be considered as a services. So now any business activity or any businessman who has an activity of purchasing and selling of goods, or maybe they provide services to the consumers or to the customers, and from that if they earn any kind of a monetary values of such kind of providing services or buying and selling of goods, it is called a business transactions, and all kind of a business transactions has to be recorded in the books of accounts. All the transaction is necessary to record in the books of accounts, but the recorded in the books of accounts where there is certain understanding. So how the business transactions will be recorded in the books of accounts? Here the business accorded accounts, one is the business specific. So as it is mentioned here, it is related to specifically to the business entity. So any transactions which is related to the business entity, it is to be recorded in the books of accounts. As I mentioned in the earlier chapters also, if I just want to recall all of you that the transactions which have to be converted into a monetary terms, that's the first thing, but it has to be for a business. Even if a sole proprietorships are there and the person who is owner of a business is doing a transaction, it's considered for the business instead of it is considered for a personal. So now if I am doing any kind of transactions for my business activity, it is considered a business transactions rather than my personal transactions. Suppose if I am going to withdraw the goods from the business, it's considered a drawings. As I mentioned, actually brought the capital in the business, or maybe I'll take a plant in the business, it's also considered a capital. So any kind of transactions which is related to me, either it must be considered as a capital or a drawings, or directly it would be affected to the business specific activity. Moving to the next is economic activity. As you are understanding of this definition, any business transactions which have to be converted into a monetary value, or it is converted as an economic kind of activity. So if it is actually a represents of economic activity, then it's considered for a business transactions. And then monetary value, as it has to be converted into a monetary value. So if the transaction has a monetary value, it's considered economic transaction. It might be, suppose if the owner is actually thinking to take a certain decision in the future, this is not a monetary transaction. Suppose if I want to tell you that I am going to invest 50,000 rupees in the next 6 months. So that is my idea. That is, I thought in my mind that I'll invest 50,000 rupees in the business in the next 6 months. So that is my idea. It is not an event. It is considered as an event, but it is not a transaction. I thought, but I did not invest. So that means it's not an economic transaction. It is converted maybe in the monetary value, but not now. When it will be converted into the monetary value, when I'll invest 50,000 rupees in the business, it can be converted into a monetary value. So this is the way to understand the business activity. Cash or credit. The transactions can be a cash or credit. It can be, suppose if any kind of a exchange of a liquidity or any kind of units which has been actually valued in a certain amount, or it exchange a value between the two party, it's considered a cash. Or sometime maybe the cash transactions is not possible, then the amount will be paid in the later stage or later part, it would be considered a credit transaction. So can be understand the cash payment or non-cash payments. Moving to the next point, that is internal or external. The transactions may be internally or an externally can be possible. Internal, it means that if any kind of transaction is occurred and takes place in the business between two departments, or maybe the internally it can be happen. Suppose if I want to charge a depreciation on machinery. So the depreciation charge on machinery, the expenses of depreciation is considered as an internal. External, it means if I am going to appoint an employee and pay the salary to the employee, wouldn't be considered an external. Suppose if I take a building on rent and paid a rent to third party, it's considered an external. If I purchase the goods from the vendors and paid the amount to the vendors against the goods, it's considered as an external. So internal and external would be also the part of importance. Now, here the classification of the business transactions. The first is on the basis of nature, then on the basis of relationship, and then the third is on the basis of exchange. First is on the basis of nature. On the basis of nature, it would be considered as a cash transactions or a credit transaction. What is the cash transaction? The cash transaction is means the payment made immediately at the time of a transaction takes place, considered as a cash transactions. Like if you are going to purchase the goods on cash, or if you are any kind of a good sales by cash, then at the time of purchasing or selling a goods, the cash is immediately transferred. So that is considered as a cash transaction. Credit transaction, it means any kind of transactions take place, but the payment made not immediately, but it takes some time, or maybe the payment will made after a few days or a few months, considered as a credit transactions. Like a purchase of goods from Manoj on so and so date of rupees 5,000 will be paid after 15 days. So that means that the goods purchased from Manoj and the payment of 5,000 rupees paid after 15 days would be considered as a credit transaction. Next is on the basis of relationship. The relationship is considered an internal transaction and external transaction. Internal transaction, as I mentioned, that any transactions takes place within the business, or within the business or between the departments, is considered a part of the internal transactions. As example is actually any depreciation has been charged on the properties, or if you are going to consider the provide provisions against the doubtful debts. So this is actually an internal arrangement, and you are going to make arrangement from your profit or from your internal sources. It's considered an internal transaction. External transactions, it means the transactions takes place between the business and the outsider party. It's considered an external transactions. As is mentioned, goods purchased from the vendor, or goods sold to the consumers or customers, or maybe the paid some rent to the people, or you take a services from the other people and paid for the same. All this kind of transactions are considered as an external transactions. Moving to the next is on the business of exchange. It's an exchange transactions and non-exchange transactions. Exchange transactions means involve any transactions with the goods and services for money or other goods. It's considered an exchange transaction. So why? Because of when you are actually purchasing a goods, you paid cash to them and you are receiving a goods from them. So that is actually a exchange transaction. So involve exchange of goods, services for against the money or maybe other the goods. That is considered a part of exchange transaction, like a sale of goods by cash or in another way. Non-exchange transaction, it means there is no direct exchange of value. No exchange of value, it means it might be the any kind of transactions take place, but the or maybe a loss or expenses, but there would be a no exchange at all. Like goods put it in a godown and suddenly it fired, or maybe it is damaged due to any reasons, through maybe a rain or any other reasons. The goods is already destroyed, goods is completely lost. But here we are not exchanging this with anyone. That is called the non-exchange of transactions. Moving to the next part, the classification of transaction. And here the classification of transactions are fine on the basis of visibility and on the basis of accounting treatment. On the basis of a visibility, recorded versus non-recorded. The recorded transactions are those transactions which can be measured in monetary value, which can be measured in money, or maybe it can be measured in the value which is actually necessary to record in the books of accounts. So the recorded transaction is considered only the measured in money, and that's why it's recorded in the books of accounts. As it is, example is payment of salary. payment of salary which we are paying to the employee. So it can be easily measured in money. That's why it's considered as the recorded transaction. Non-recorded transaction, it's those transactions which cannot be measured in money. So it cannot be measured in money or a monetary terms. It's considered a part of non-monetary transaction. As I take the, if you remember, I just took an example in current lecture only, that if I'm thinking that the 50,000 rupees investing in the business in the next 6 months. So that is event, that is actually thought process in my mind, but I'm not investing right now. I'll be investing in the next 6 months. So that means it's just an thoughts which has not been actually having any kind of a monetary value transferred or monetary value process. So that's why it's considered non-recorded transaction. Capital versus revenue. What is capital transactions? Capital transactions is the transactions which are having a capital values or a capital expenditures. Like if you purchase any kind of assets, or if you are purchasing land, building, plant, machineries and other things which is actually helpful or which will be used in the business for a longer duration, and if these assets or these expenses will help you to generate the revenue, that is considered as a capital expenses. That's one is, if you are purchasing and selling of assets, it's considered a capital transactions, and which is actually a long-term impact on business, which is helpful to generate the revenue. The next is revenue transactions. The revenue transaction means the transactions which are helpful or related for a day-to-day transactions and to generate through the day-to-day transactions revenue for the business. It is considered revenue transaction. So day-to-day business activity, it's considered a revenue transaction. Moving to the next, the dual effect of transaction. Any transactions have a minimum 2 effects, as it was actually discussed at the introduction of the lecture. The dual effect of transaction is, that is basic understanding and basic fundamental principle is that any economic transactions have at least 2 effects, minimum 2 effects. So that is the double entry of bookkeeping, which says that the minimum at least 2 accounts, and there are any transactions have a minimum 2 effects which is affected with the minimum of 2 accounts. As I was actually taking an example that 5,000 rupees cash brought into the business. So what comes in? Cash comes in. Who brought this cash? Owner. So one is cash account and the second is capital account. So one is cash account, the other one is capital account. So in that sense, the 2 accounts were affected. There is ensure that accounting equation always balance. Means how much you brought the cash in the business? 5,000 rupees. So the 5,000 account is debited, and who brought this business cash in the business? That is owner. So it is the form of capital. Again 5,000 rupees will be credited in the capital account. The amount is equal and equation has to be matched. So this is the way that amount has to be matched with this. So now this is actually a part of the equation. Moving to the next. Here the accounting equation has to be matched with this particular formula. So this is the important formula. A is equal to C plus L. A is assets, C is capital, and L is a liability. So this is the formula where any transaction has to be matched with this A is equal to L plus C or a C plus L. So here if you are going to do this transaction, I'll explain you how. The C is capital. How much amount of capital comes in the business? So here A is equal to C plus L or L plus C. In the previous transaction as well, I was explained you that the 5,000 rupees cash comes in the business. So cash is an assets. So 5,000 rupees is assets. It is actually comes into the business in the form of capital. So 5,000 rupees, it's a capital. There is any liability in this transaction? No. So how much is capital? 5,000. How much is assets? So its equation is balance. So this is the way we need to understand this formula. A is equal to C plus L. Whenever the transaction takes place, both the side equations are affected equally and it is always balanced. Moving to the next part. Every transaction has two accounts and it has an equation is balanced. That is what already discussed. Now, types of accounts affected by the transactions. That was already discussed in the previous chapter. Just I'll revise you again. The personal account is there. There are three accounts. One is personal account, then the real account and the nominal account. Which accounts were actually affected in the transactions? So there are three accounts. One is personal account, that is number one. And what is the rule of personal account? The personal account rule is debit the receiver, credit the giver. Debit the receiver, credit the giver. So that we have to remember it because of each transactions we have to apply the rules and we need to identify it. Here the person gives a benefit to the business or receives a benefit from the business. This actually relates with the dealings with any individuals, firms, enterprises or whatsoever. But the person may be a legally exist or it might be a live person. Moving to the next. Now here the real account. This is the second account. As we have discussed, rules of the real account is very clear. Debit what comes in, credit what goes out, right? So here in case of this, any increase or a decrease in the value of your assets, property or a real estate, then it's considered a part of your real account. It might be a tangible or an intangible, but it is affected to the real account. So that the rules is applying here. The debit, it's what comes in and credit what goes out. Now moving to that third account is the nominal account. Nominal account is actually represents any kind of expenses and incomes. If there is an incomes, it is credited, but in case of an expenses, it is debited. So debit all the expenses as well as losses and credit all the incomes and gains. And in that case, any kind of expenses incurred in the business or expenses and losses incurred in the business or gain and profit incurred in the business would be affected to the nominal account. And what kind of expenses? Like a salary, like a commission, like an advertisement expenses, or maybe paid a rent or etc. and etc. Maybe received a commission or brokerage or commission or interest or dividend. These are the incomes. So all these things are affected to the nominal account and these are the types of accounts which will be actually affected to the each transactions. So ultimately any transactions can be bifurcated in these three accounts only. It might be any transactions were affected mixed match also. All the transactions have a twofold effect or maybe a multiple effect. Then the one effect may be affected the personal account, the remaining all transactions affect with the real account. It might possible that one transaction is affected to the nominal account and the remaining part of the transactions may be affected with the personal or maybe a real account. So it is quite possible this way we need to identify the transaction has to be post-mortem, that this is the way the transactions will divide it. After we can find out the types of account of transactions, then we apply the rules and regulation, and after the apply the rules and regulations, we'll find out the debit and credit. So moving to the next part. This is an example. That is what I want to explain you here. Now I'll explain a few transactions to understand how the transactions will divide into the types of accounts and then apply the rules and regulation of the types of accounts will identify the debit and credit. Now let's start with this first transaction. Business commence with rupees 45,000. So business commence with rupees 45,000, it means the transactions we need to postmortem first. Business starts with the 45,000, it means something comes in. What comes in? Cash comes in. The cash comes in and that is actually the effect with the cash account. So here the account is cash account, right? And it start with the capital, it means who brought this cash in the business? Owner. If owner brought the cash in the business, it means it's always form of capital. So the another account is the owner introduced this capital. The second account is a capital account. So there are two accounts. One is the cash account and the second is capital account. If you want to tell us, that's very simple way. The cash account will be debited by 45,000 because of cash comes in. So cash debit. Who is a giver? Owner is a giver. So owner's capital account is credited with the same amount of rupees 45,000. So this is the way to solve the transaction. Moving to the next account. Next transaction is bank account opened with the Bank of India by depositing rupees 75,000. Here, the bank account opened. Where opened? The amount, the name of the bank is Bank of India. So who is a receiver? Bank of India is a receiver, or a bank is a receiver. We can specify the name also, because of ultimately we have to debit with the name. So bank is a receiver, but which bank is a receiver? The Bank of India is a receiver. So Bank of India is a receiver. So it should be, receiver is always debit. So Bank of India is account debit. And what we are depositing? Naturally, if we are depositing, that means the cash will deposit. So what goes out? Cash goes out. So which account will be applied here? In case of cash, it is real account. So in case of a real account, if the cash goes out, so it is always credit. So cash goes out, effect of cash will be credit. Correct? So this is the way to find out the transaction solution. Moving to the next is goods worth rupees 6,000 purchased from Rajat. First of all, what we need to find out? Whether the transaction is cash transaction or a credit transaction. The goods worth of rupees 6,000 purchased from Rajat. Why? This is a credit transaction. First of all, I'll explain you why. Here, the cash is not mentioned anywhere in this transaction. That's the first analysis. The second analysis, that the name of the person from where we purchase the goods is mentioned. So that's why this is a credit transaction. The two important thing is, one, the cash is not mentioned in this transaction, and the second is the person who supply the goods, the name is mentioned here. So that's why this is the credit transaction. So first we find out the credit transaction. Now we'll find out further that which two transactions and which two accounts are affected in this particular transaction. Goods worth purchase. What comes in? If you are purchasing, that naturally goods comes in. So goods comes in, it's your first transaction. Correct? And from where we purchase these goods? We purchase from Rajat. So who is a giver? Rajat is a giver. So Rajat is a giver, it's a second transaction. So goods comes in, so goods account debited or a purchase account debited. We can use the purchase word. When goods comes in, it's a purchase. When goods goes out, you can use the word sales. So goods comes in, it's purchase account debited, and Rajat is a giver, so Rajat's account is credited. Moving to the next transaction, goods worth rupees 9,000 sold to Kavita. I think you can easily imagine this transaction. It's a cash transaction or a credit transaction. It's a credit transaction. Why? Again, the same way here, the goods worth rupees 9,000 sold to Kavita, the name is mentioned and the cash is not mentioned. So that's why it's a credit transaction. Again, here, goods sales. So what goes out? Goods goes out. And we are selling the goods to whom? To Kavita. So who is a receiver? Kavita is a receiver. So Kavita is a receiver. In case of Kavita's account is debit. And what goes out? Goods goes out. So that's why the goods goes out, the sales account is credited. Moving to the next point is goods sold worth rupees 3,500 for cash. Goods sold for rupees 3,500 for cash. So this is very clear. This is cash transaction. Why it is cash transaction? The first is the cash is mentioned. Second, the name is not mentioned anywhere in this transaction. So it is clearly identified that this is a cash transaction. In that case, the goods sold at rupees 3,500 for cash. What comes in? Cash comes in, because of when you are selling, something comes in. So cash comes in, cash account is debit. What goes out? Goods goes out. So goods goes out, it's kind of to sales account. So cash account debit and cash account that ultimately cash account is debit and goods account is credit, sales account is credit. Next is purchase worth rupees 2800. So here you are purchase furniture. Furniture is an asset. We already mentioned it. Land, building, plant, machinery, vehicles, furnitures, computer equipments, all these are the assets which will be used in the business for a longer duration. So ultimately the assets or the things which are actually used for a longer duration are considered as an assets. So here the furniture, it comes in as per the real account. Furniture account is debit, and then what we paid against the furniture purchase? Cash paid. So cash goes out. So that is both are real account. Furniture comes in also real, cash is also real, cash goes out. So one is comes in, furniture account debit, cash is goes out, so cash account is credit. I'll take one more transaction last, and then remaining transactions you can do it by yourselves. So here the commission paid rupees 450. Commission paid 450 rupees, it is part of the nominal account. Why it is nominal account? Because of we paid something. The commission, it's an expense. Might we got some services from the other people, and against the services, we paid the commission to them. So commission is an expense. That's why the expenses are debited. So commission account is debit, and when we paid, that means something is goes out, cash goes out. So we paid cash, cash goes out, commission account and cash account. So as per the commission account is debit and cash account is credit. One more transactions I'll take. Kavita returned goods worth rupees 380. So here we sold the goods to Kavita, and from the Kavita the some amount of goods is not as per the sample or as per the requirement. That's why the Kavita returned the goods. We sold to Kavita, and as it is returning from the Kavita, that means who is returning? Kavita is returning. So Kavita is a giver. Goods comes in. Which goods comes in? Which was sold earlier. So here the word is used sales return. When goods comes back, which was sold earlier, so goods comes back with the effect of sales return, that is the goods sales return account, that's the first account, and written by the Kavita, so the Kavita's account is credit. So sales return account debit to Kavita's account. So this is the way to find out the types of accounts and the twofold effects. So how the types of accounts is actually identified through the various kind of transactions. After you identified the types of accounts from the each transactions, then you need to identify which transactions have an applied of which particular account as per personal, real or nominal, and then apply the golden rules, and then you find out how the transactions will affect in the books. So this is the way we can actually bifurcate an analysis of the all kind of economic transactions and how it will be recorded in the books of accounts. I hope you will be understand properly and you will practice by yourself. All the best. Thank you so much.